So this is an interesting class. It's an insurance class. I understand why the actuaries are taking it because they're trying to decide if I've somewhat been trying to skew them that the life side's the more interesting, but the P&C has more jobs, and you want to avoid the benefit side. But I understand actuaries. So why would you take this class if you're not an actuary? Maybe you need an elective and there weren't any other electives, but this is an important part of insurance that you all have to buy. So those that took my life class know how negative I was on that industry. Guess what? A friend of mine goes, Ron, I got this annuity. I wonder if you'd look at it. Guess what kind of annuity it was? Equity linked annuity. Guess what I told him? And he says, that's what I thought. Yeah, I'm going to avoid it. So, so that industry has some good products, but that's not what they sell because they don't get commissions on that. The P&C side, I'm not as negative on, although it's much more negative in the press than the life side, mainly because people hate their auto insurance, they hate homeowners. People in Florida can't get a policy. It makes a lot more negative press. The life side should have more negative press, but people don't understand the products, so no one knows what to complain about. Everybody understands auto and homeowners. So will there be some practical stuff here to talk about these products, how to look at them, how to compare. It's a much more competitive industry than the life side. The life side, you always shop 5, 6, 7, 8 companies because there's a big difference in pricing because of State Farm and Allstate and Geico and Progressive. Their actuaries know what the others are doing, and they try to stay somewhat in the ballpark. Not that you shouldn't shop rates, you definitely should, but it's not as critical on the life side. You're not going to save as much shopping between Geico and Progressive and USAA as you are on the life insurance side. So there is a practical side to it. I worked for USAA for 23 years, got to know the actuaries on the P&C and life side very, very well. Worked a lot with both sides on some of the issues on the products we're going to talk about. The challenge I have with this class is I've never worked for a commercial property and casualty company. So that part you're going to see is going to be really textbooky when we get to it, but it's going to be a short part of the class because it's not my favorite. Plus, personal auto is not that radically different than commercial auto. They're very, very similar policies. There are some differences. Obviously, workers' comp is something that businesses have that you don't have as an individual. I will get controversial because I just like to keep everybody awake. And there's a few pretty controversial topics here. I think what's funny though is the topics I bring up, a lot of my students don't know if they have that product or not, which always amazes me that people are spending money on something and they don't know that they have it or not. Like parts B and C of auto insurance. Do y'all have that? Anybody know they have that?
Auto insurance?
Parts B and C of auto insurance. Yeah. So if you don't know, guess what you are doing? You're buying it. Should you have it? I don't have it. I think it's a waste of money, but all of y'all have it. I'm not going to convince you to change because I never win that argument, but I think it's a waste of money. But we're going to talk about those things. I'll give you the arguments people make, and I know what your insurance company will tell you if you call them and say, I'm thinking about canceling B and C. Oh, you can't do that. But the person who's telling you not to get out of that product, they have a little bit of incentive, don't they, for you to buy their products. So I have some controversies. The most controversial thing we're going to talk about is credit scores. So that one's a little bit touchy. We're going to talk about what the state of Texas went through on that. So there's definitely some serious issues there. There is some tediousness to it where we just have to get through some products. But I don't teach it like a traditional insurance class. Most insurance classes, you study the contract and you learn the exceptions to the contract and you learn the exceptions to the exceptions to the contract. I think all of that's a waste, mainly because there are 50 states and Puerto Rico and Guam, and every state is different. So if you're going to be selling this product, you're going to learn a state. And so we have to keep it fairly generic. So I don't want to go into all those details. You'll learn that if you do that. This is not an insurance sales class. It's a finance class. I'll try to make a little bit actuarial, but I'm a little weaker on the actuarial side, on the P&C side, than I was on the life insurance side. It's a little bit tougher. Their math is a little bit more complex because there's so many more factors that they're bringing in. So The other aspect of this is if you interview with a PNC company, this class can certainly help you sound much more intelligent in the interview. And I'll give you some clues on how to research the company that you're looking at. So on Canvas, I have the syllabus and the class notes. We'll be going mainly through the class notes. You can definitely read the class notes in advance, but I can tell you for right now, what I want you to do is really work on paper one. And we'll do some of that tonight. And then we're going to get in to the economics of the property and casualty insurance and talk about that, things like rate online and capital asset pricing model and what it says about insurance. There's some pretty fascinating things there. And then we'll work a lot on this paper one here. And then we're going to do product by product. It's the same way I did the life insurance class. We're going to do it product by product and then get into the special issues at the end. So we're going to start with homeowners. And what we do is I cover the product and I cover a special issue for the product. For homeowners, it's catastrophes. No questions. That's their big thing, hurricanes and earthquakes. And then I'll have some math problem that we have to do. And then we'll go into auto insurance. We'll cover that. Then we'll do the special issue, which for auto insurance is going to be credit scores. And then we'll have some math that we work at the end of that. So that's the way it's structured. So homeowners first. Y'all know what PML stands for? So we'll learn what a PML is. Reinsurance, y'all know what reinsurance is. So y'all probably have heard that, some of y'all. Then we'll do auto insurance. There's the part B, C debate right there at top. Then we're going to spend quite a bit of time on credit scorings. Then commercial, which is not my favorite, but talk about tort. The two biggest issues there are asbestos and probably professional liability. Not a big of an issue. Both of these, I can't think of a really huge issue right now, but asbestos was a huge issue many years ago. And then professional liability, we had doctors leaving the profession because they couldn't afford their premiums. So we'll talk some of that. So a little bit on workers' comp, show you some interesting videos on that. Then pricing. Now, those that took my life insurance class, those formulas were pretty straightforward. They're not so straightforward here. I'm going to do it the way I do it because I'm a finance person. I showed that one of the head actuaries at UTSA how I did it. She's like, oh, you can't do it like that. This is how you do it. And she showed me this formula that went on for 40 pages. It's like, I can't do that to finance majors. They don't have that ability to do those type of formulas. So what we're going to do is set up the formula just like she did, but instead of solving it, we're going to back into the answer using trial and error. That's the way I have to do as a finance major because the math is far too complex. I got the exact same answer she got. So it wasn't like I was doing it wrong. It's just that she was a little more emphatic about it. The big thing on insurance, which is one of my favorite topics, is Schedule P. Schedule P is a great schedule insurance companies publish. It's very fascinating. You can get a lot of Schedule Ps online for the companies. We'll probably look at all states, maybe Met has a P&C company. So I love Schedule P. We will spend some time on insurance accounting because there are some really unique things for insurance accounting that you don't see anywhere else. In fact, I was an undergraduate accounting major and 30 hours of accounting, which I think now they require 36, but 30 hours of accounting. And then I became an accountant at USAA. And it's like, wow, none of this stuff, they didn't teach us any of this stuff. I think I could have had 6 hours of accounting and debits and credits and balance sheets, income statements, because so much of insurance accounting is so radically different. The biggest liability on an insurance book is a reserve. It's a huge estimate that actuaries do. So the most important part of the accounting for insurance companies doesn't even come from the accounting department. It comes from the actuaries. So we'll talk through some of those, talk about reserves and some of the premiums that they have. We might spend some time on investing. Hopefully, that was a big project I did at USAA. I was sitting at my desk one day, minding my own business. I get a call and they said, Ron, we got this new department. They want you to work in that department and you can't say no. So it's okay. So what's your choice? I said, well, say yes. And the department was 3 people and they were going to take the 3 people, take them out of our jobs. One was a senior officer. I was kind of a peon analyst and one was from a real estate company. And they said, you're going to sit here for a year and work on nothing more than what a property and casualty company should be investing in. And that was our only job for a year. And we wrote a massive book. I learned so much. And then I went around the country presenting it because no one else had done that. It's like, what should State Farm be buying? So it was an interesting project. So I'll give you some of that background. There's still not a definitive answer, but there are some huge differences. I don't know if you remember in the life insurance class, how much stocks do life insurance companies buy? Do y'all remember that? Yeah, it's essentially zero. Property and casualty companies will buy quite a bit in stocks. So why does one buy stocks and the other? Life insurance companies buy almost nothing but bonds. Property and casualty companies, USA had 20% of its net worth in stocks, or even more than that, 20% of its assets. And they had real estate. USA has real estate. Life insurance companies don't usually do that. So the investing for life insurance is different than property and casualty. So they are different businesses, to be sure. We will spend some time on regulation. That sounds boring, but actually, if you're interviewing with an insurance company, insurance regulation is a huge deal. And I find it really fascinating because it has a history to it. We didn't get to it much in my class because I spent way too much time on healthcare. And we have to talk about healthcare in here too, because we got workers' comp and some other things. But I'll try not to get off my healthcare tangents again. So we'll probably spend a little more time on insurance here, but there's actually a unique nature to insurance regulation for property and casualty insurance companies that you don't have in the life insurance side. And that has to do with rate regulation. Life insurance companies can essentially charge whatever they want to. For property and casualty companies, they have rules that they have to fit, and it depends on every state is different. And in fact, some states, like Georgia is probably the worst, every county in Georgia is different. So you can get, those that are actuaries, if you become a pricing actuary, you won't become a pricing actuary, you'll become a Arizona pricing actuary. You're going to be specific to a state. And we'll talk about that. I have a lot of experience with that because I was really fortunate that when the actuaries file with the state, they have to have an investment portion to what they file, because we're going to talk about float. When we talk about float, what happens when you buy an auto insurance policy, you pay your premium today, but you may not have an accident for 9 months. What are they going to do with that money until you have your accident? And that's where I, as the investment person, comes in. And I'll tell the actuaries, well, we can make 5% on that. We can make 4% on that. And those that know me, you know what I did is I made sure I learned their side of the equation as well, so that I could, gave me an excuse to talk to them. I had a blast doing that. Really smart people. What intimidated me was they knew as much about finance as I knew about finance, and they knew a whole lot more about actuarial science than I knew about actuarial science. How many actuaries do we have in here? 4, 5. Okay, wow, that's quite a bit. That's a good group. All right. Maybe I'll see if I can get a USA actuary to come talk to us. That would be pretty good. They've hired 4 of our actuaries that I know of. What was her name? One of them is here. I think I can get one and come speak to us. So that would be pretty interesting. All right. So regulation is very unique to insurance, and even more unique to the property and casualty side. Let's walk through the syllabus. So one student was all mad at me last class because I count attendance. This is my thing. I require attendance just because it gives me better classes. Students who don't like to come to class avoid my classes, and there's a high correlation between students come to class and engagement. So it's just my thing. So I'm going to do it. I'm getting the impression that we have these massive buildings and no one's sitting in them anymore. Are y'all going to classes with no students are there? So I don't know why parking's a problem anymore, because it's like everybody's doing it online. But I'm sticking to it, and I'll retire if I don't want to talk to a computer. Yep. I want to know who you are so I can reference you for jobs, and you need to network with each other and those kind of things. But I do give you 3 outs that you can make up by sending them in your notes. And even then, if you miss a few other classes, it's not going to start hitting your grade until you get beyond that. So even then, my requirements are actually less than what UTSA requires. UTSA is like they should get an F if they miss this many. I'm not anywhere close to that. But no one follows UTSA's guidance. So I will put every class out there on my YouTube channel, usually by Saturday. So if you miss it, but don't overly rely on that because some of y'all know sometimes I mess up, forget to do the share screen and all that kind of stuff. So, it's possible I'll miss a class. So we have 2 exams. Those have had me before. I tell you exactly what's going to be on the exams. It's going to be just like that. Every exam will have some math and some essays. This class has some pretty weird essays, but I'll help you quite a bit on them. The credit scoring is one of those that has a huge essay. Your first paper is a float paper, and we're going to start talking about that tonight because that's what I want you to start working on. I want you to start getting that paper out of the way. The second one says student topic, but I'm going to get into that more after the first paper. Don't worry about it. But we're going to have certain topics we'll let y'all decide, and you can kind of work together. But you submit your own paper, but finding articles and finding places to go. It's getting a little tough to do that because of GPT, so I have to have some controls over it because I don't want to read computer-generated papers. You can get 1% just by doing the course survey. So I'm here most afternoons, Monday through Thursday. I'm not here on Fridays, but you can call anytime. I'm on a bike every morning, so just call. I can talk to you. I was on a bike yesterday morning. I assure you I was. It was 17 degrees when I was riding. And that's not the coldest. I rode a bike in 2021 when we had that major snowstorm, and it was like even colder then. When I got home, my chains were frozen solid. I couldn't pedal because it was frozen. So that was the coldest I've ever been. But so I'll be on the bike, not for 4 hours if it's 17 degrees, but I'll generally be on the bike 3 or 4 hours. So you can call me. You can set up a Zoom. I really recommend if you're worried about papers, set up a Zoom before the paper's due. I'll walk through it. You can record it and get all the notes because I talk pretty fast and you won't be able to write it all down. So I'd rather some students are like scared to show their paper to the professor because they don't want to. You're like, oh, it'd be embarrassing, but it'd be better to be embarrassed before I grade it than after. Make sure. Some students, especially on this first paper, I can assure you on this first paper, some students lose the easiest points. I want something really simple and they don't put anything at all, and they could just have written 2 or 3 sentences and they're going to lose like 10% because of that one thing. So if you set up with me and I see that, I'll absolutely say, hey, you're going to lose some points because you don't have that in the papers. So I would, some of y'all have had me before, you're kind of used to my style, but if you're not sure, give me a call or you set up a Zoom. So anytime is open other than when I'm teaching a class. So I'm pretty flexible. Usually not after 11 p.m., usually not before 6 a.m., but any other time I'm usually pretty flexible. You can call me. I don't like text because I forget text. So emails are a lot easier. I have a working file for my emails. I prefer that. But if you text me, I'll try to get back to you. There's my email accounts. All right, so the first paper is on float. The exams, the essays, I generally make open book. The positive of that is you don't have to memorize a lot of stuff. The negative is I'm pickier on the responses, but I do give rubrics for their essays to try to help with that. That's another thing. You could meet with me before the exam, make sure, because some students, again, lose some just obviously easy points on the essays, just leaving off the most obvious things. So your first papers due kind of quick, a month from now, February 16th. Exam 1 is before spring break, and you'll see the exam. The big math problem in exam 1 is pretty cool. It's securitization. If y'all did the equity annuity last semester, securitization has some very similar mathematics to it. If you don't know what securitization is, y'all probably do, right? You've heard of mortgage-backed securities and asset-backed securities. Well, what the insurance industry has done is they securitize liabilities. You want to guess what insurance company invented that? What's the famous company that did the first securitized catastrophe bond?
Allstate.
Who?
Allstate.
Not Allstate. You could almost throw a rock at their building, though. So USAA invented the cat bond. That's pretty. I was there when they did it. I remember the actuary who did it. smart guy. And so USAA started this market, and it's still out there. It would make a great topic for paper 2. I just wish our class were in the fall, because what I'd like to do with the cat bonds, you lose a lot of money if a hurricane wipes you out. And what I'd love to do, one of these days I'll have to do it, is there'll be a hurricane out in Gulf of Mexico. I want to watch that catastrophe bond on the Bloomberg screen and see how its price is moving. I think that'd be really, really cool. But anyway, so we'll look at that. You can actually type catastrophe bonds in USAA and you'll get the entire history of them. So USAA is a big part of that. So I'll show you how to do that math. We'll also do some PML on the first exam. So you have that math. And then on the second exam, the math is pricing of the policy, which is a really cumbersome problem, but you'll see. So we'll go from homeowners to auto to commercial, including workers' comp. Spend some time on pricing, probably not that much time. Spend some time on accounting and investing and regulation. So yeah, it's going to follow kind of pretty obvious topics as we go. Least favorite's the commercial insurance, but that's only a small part of it. I have some background with workers' comp only because when I was going around the country making presentations, there were 3 of us, and one of the presenter was a workers' comp person. So I got to talk to her quite a bit. So what are you guys working on? What are you doing? But I've never worked for a company that actually sells workers' comp. All right, any questions on any of this? So let's talk paper 1, because that's what I want you to work on. In fact, there's really not a reason to read the notes in advance. You can if you want to, but we'll cover all the notes in class. So, you can certainly do that. I'll give you some hints on some things you could look up on your own. There is a podcast. Oh, I can't remember the name of it. I'll have to find it. There is a really good podcast on this industry. And it's got a really strange name to it. I'll find it and get it to you. Especially you actuary majors, y'all should listen to it. It's kind of amazing. There's a podcast that's for P&C actuaries, but that's what it is. Some really interesting things. They had someone, a really good paper 2 topic. They had one of their podcasts was with a company called Root. See if I can find it here. And what Root is famous for is it's the company that really uses AI tremendously for pricing its auto insurance. And so I've been tempted to just get a quote from them. What you have to do, they use a lot of telematics. If you've heard of telematics, we'll talk about telematics. Some of y'all might have it in your car where it monitors how you're driving. Are you using your phone, or you make hard stops? So Root is trying to become the AI champion of auto insurance. And I think that's really, really fascinating. I'm sure all the other companies are using AI as well, but they had one of the people from Root on their podcast. So I'll have to find that podcast and get you the link, because it's a really, really good one. All right, so paper 1. I have to remember you guys weren't alive at 9/11. So were any of y'all alive? None of y'all remember 9/11. Right? So 3, do you remember it?
No.
No, you were like 1 year old.
2 years old.
Yeah, I was alive when President Kennedy was assassinated, but I was 1 year old. So I don't remember that one. I don't remember the Bay of Pigs, because that was when I was born. Yeah, so why would I do something so old? And the reason I do it so old is 9/11 was obviously a really tragic event, was also a huge event for this industry. And as a result, Warren Buffett wrote a special annual report about the insurance industry. He has updated it in other annual reports, but he never went back to do it as detailed as he did it in the 2001. And it's really still topical today. So it still works. So don't feel like it's old stuff. Everything he's saying is really good. I don't know if y'all know that Warren Buffett, Berkshire Hathaway is primarily an insurance company. That's his biggest business, Geico, and then it's got these massive reinsurers. And so he lost a lot of money 9/11. Now you say, how did he lose money? Well, think about it. How would an insurance company lose money? So what's the most obvious thing?
That's
Oh,
hurricane.
well, but I mean for 9/11.
The claims, the death claims or
Okay, so death claims. Now they're not a life insurance company though. So
Oh,
why would
okay.
why would a company pay death claims for property and casualty? I've mentioned it, so
The
What?
buildings.
the buildings, all right, so property damage is a huge one, right? So that's a big one. But what else would there be? Death claims is correct, but why would death claims be on the property and casualty side? They're on the life insurance side too. At USA had quite a few losses from 9/11 on the life insurance side, but why would the property and casualty, what product would have paid death benefits? What product pays when employees are killed or injured on the job?
Oh.
Workers' comp, right? So it's a huge workers' comp.
um,
Why did Warren Buffett miss there? Well, Warren Buffett said, we don't have a risk because we have like 20 different employers. So it's diversified. How diversified was he? Not very well, right? They're all in the same building. So workers' comp and property were the two largest ones. And he says he learned his lesson in doing this, and that's why he wrote the annual report. Some of y'all probably read Warren Buffett's annual reports. He tries to draw people in with some really insightful. So what you're going to do is write a paper on this, and I'll give you the rubric. There is a rubric, and you can follow it. But I want to walk it through the night so that when you read it, you're ready to get into it. Now, don't print this thing. I gave you the entire annual report, but you don't need all of it. All right. So let me get it loaded here. I've pushed that so many times. I should put it in the description. I will. I'll change the description when we get back to it. So, so where we're going is now you have two page numbers. See that says 3 of 74, and you see that says 2. All right. Go with the page number that's typed. And you're going to come down to page 6, bottom of page 6, and it says the economics of property and casualty insurance, which is exactly what we're doing to start here. All right. And you go from the bottom of page 6. We're not going to use all of this. There's a little bit of this we're just going to maybe get to later in the semester. But you go from 6 to the top of page 12. Say 12. Yeah. Yeah. Actually, and I'll just tell you, page 11 is the part we're not going to spend as much time on. So you won't really do much of page 11 on your paper, but we will talk about it because he's talking about loss development, which is not really part of paper 1. You are going to spend some time on the top of page 10. And a lot of students forget to do this. So I'll try to spend more time in it this semester to make sure no one misses that. All right. So it's not that much to do. And so what Warren Buffett is doing is he's saying, okay, we lost a lot of money because of 9/11. It's because we made some mistakes, made some basic underwriting mistakes. What should we have done different? What did we learn? And that's what he's writing about here. He's brought it up almost every annual report since. So that was an unusually big year for them. So he brings up the word float. Now, y'all probably have heard the word float. Well, maybe not. Y'all don't write checks, do y'all? Have y'all heard of float? Your grandparents probably know what float is. What is float with a check? You remember hearing the grandparent talking about floating checks? Floating checks is not the same as kiting checks. That would be illegal, but floating checks.
is that like post dating it, or is that before we could verify checks like the same day? So
Right.
you could write a check today, but it won't clear for
Right.
another 3 days.
So you might have $100 in your checking account, but you write a $200 check, but you know your pay is going to hit tomorrow, and so you're floating that check. So yeah, it's floating just means there's a delay. That's not exactly what he's talking about here, and it can get a little tough because he doesn't give a real clear definition. We'll talk about it in class. I'll give you a broader definition, but he says the insurance business works based on the amount of float it has, how much that float costs, and what the future of that holds. So what is the amount of float? Well, let's first of all figure out what float is. Now, this definition is not too helpful. It's money we hold but do not own. So that's kind of like you write a check at HEB for $200, and it's HEB's money, but they haven't taken it out of your account yet. It's still in your account. So maybe you're making a half a penny in interest. All right. But it's not your money. You got to make sure you have that money. But it's in your checking account. It doesn't belong to you, it belongs to HEB. All right. So money we hold but do not own. What's another word for money you hold but do not own? Can you think of other words for that? Debt, exactly. All right. You borrow money. Is that your money? No, it's the bank's money. You got to pay it back to them. That is a good way of thinking about what he's talking about here. Think of it as debt. But it's not debt, but it's like debt. And essentially what Berkshire Hathaway is saying is I can borrow money two ways. I can do it through my insurance operation, or I can go out to the capital markets and borrow money. I don't know if any of you are Geico customers, but it's essentially what he's saying. My Geico customers are really cheap source of debt. And how cheap are you? What's the lowest you've ever paid on some debt? Have any of y'all ever paid a negative interest rate on debt? Any of y'all borrow money and borrowed $1,000 and paid $900 back? And that's what the bank wanted. That's what Warren Buffett's saying he's doing. He's borrowing $1,000 and repaying the debt with $900. Does that sound like a good source of debt? Sounds pretty cheap, right? Negative 10% interest. That's what he's saying, is that insurance is a source of debt, and that's why Berkshire Hathaway works. You can read articles about it. Insurance is a source of debt that is really cheap and actually be negative. Now, it's not exactly debt. So another way of defining this, because it's not literally debt, but it will show up as a liability in reserves. But another way you can think about this is time. You want to think of the word timing. We pay our premiums today, but we don't get claims until the future. So the insurance company gets your money today, they invest it, and then when they pay it out, they pay you. So if you pay them $1,000, they may make $50 on it while they're waiting to pay you. So they're making money. So if you think about it, I want to make sure everybody's clear. So some students get really confused on this. Let's say the premium is $1,000. There's a time delay where you make $50 in interest, and you pay claims later of, say, $950. All right, so what is the float? The float is essentially the $1,000 that eventually gets paid out of $950. The float is that money they received, like borrowed money, and then they pay back at $950. How much did this float cost them? Negative $50. I mean, if you knew for sure you could do this, how much of this would you do?
A lot.
Yeah, I do a few $1 trillion, right? I'd take $1 trillion in, pay out 950 billion, you got $50 million gain with no risk, or 50, whatever. No, that's how you want to do it. This $50 is not the float. The $50 is the earnings on the float. Okay, so don't get the earnings on the float mixed up. Why is this important? Because insurance separates cost of float from the investment earnings on the float. It's extremely important.
So the premium would be the float.
Well, it gets a little confusing because he's taking in 1,000 and he's paying 950, but technically the $1,000 is the float. It gets a little tricky because he's going to say, so we're saying float is money you have, don't own. You can say float is like debt. But another thing he's going to say, which Jalen, to your point, gets a little confusing. He's also going to say float is your reserves on the balance sheet. And so the problem is the reserve on the balance sheet is actually the 950 because that's what you got to pay out. I don't want to get technical in this paper. Is the float the 1,000 or is it the 950? He doesn't make that clear. Most insurance companies are going to think the entire 1,000 is the float, but technically what he's going to measure is what's going to show up on the balance sheet as a liability. So this person comes in with $1,000 and the actuaries say on average we're going to pay out 950, so that's what they're going to put on the balance sheet. Essentially that 50 bucks is just profit. All right, so it gets a little confusing, but you don't need to get that technical. You can almost think about it as they take in 1,000, they pay it 1,000 and make $50 in interest. So the float is the same whether it's the premium or the liability. But yeah, it can get confusing, but don't get into that confusion in here. So he technically says his float is what he has in reserves on the balance sheet. And you only reserve what you're going to pay out, not the entire premium. So this is not float. It is earnings on float. And here's a huge difference between life insurance companies and property and casualty companies. For life insurance companies, the investment earnings is integral to their entire product. That's just all part of it. Property and casualty company always separate out that investment earnings from everything else. So what is the cost of float? This is not the cost of float, that's what you're earning. What is the cost of float? The cost of float is going to be your premium minus what you pay out. That's the cost of float. Now on the paper, you got to be real clear because there's a term for this. So let's talk about the payout. What does the company pay out?
$950,
Uh,
they pay out $950.
yeah, but I mean, what's the term? So Camille mentioned it. Claims, right? Are they going to pay $950 in claims? Well, no, because what else do they have to do? They have expenses, don't they? These are known as underwriting expenses. That word underwriting, we'll talk about a little more. But that's your salespeople, it's your accountants, it's your actuaries, it's marketing staff, your the sales rep, not the sales rep, but the claim, policy service people, those are people you call to change your address. There's one other expense that they break out. Do you want to guess what that would be?
Probably like the manufacturing. I don't know.
No, they're not manufacturing here because there's no product, right? So it's something that's not in this. I see what you're talking about, but you're exactly so. Jalen, I think you're getting to the cost of goods sold, right?
Mm-hmm.
So claims is definitely part of cost of goods sold, but what else would be part of cost of goods sold? So let me put the word up there and see if y'all know this word. Adjusters. Have y'all heard of adjusters? So it's those people who are involved in paying the claims. So we call it loss adjustment expenses. Also known as LAE on the right. So LAE, we'll talk about ALE and ULE a little bit later, but LAE, loss adjustment expenses. So not all the money goes to the customer. Now, how much of this was auto insurance? I'm going to give some guesses here. This might be 65%. This might be 20%. And this might be 10%. That may be the typical. So what does that mean when you buy an auto policy? On average, you're going to pay them a whole lot more than they're going to pay you. Quite a bit more. Is that unfair and unethical? Well, we'll talk about why would you buy auto insurance when you know on average you're going to pay a lot more to the insurance company. What's the key phrase I'm using? On average. If you knew you're going to pay average every year, you would just pay it yourself. What's the problem? It's really lumpy. Sometimes it's zero, sometimes it's zero, sometimes it's zero, sometimes it's $25,000. And that 25,000 is so disruptive to you, you're willing to pay much more than that on average over your life, just so you don't have that big lump all in one year. But all right, so we're gonna have something you're gonna have to put into the paper. It's called the well, this I don't think he uses, now be real careful on this paper. There are some things I'm looking for in your paper that aren't necessarily in this article. All right, so we're going to add some stuff on the edges. So you'll have to use your class notes in addition to this. But there's something called, I wonder if any of y'all have heard of this before. Combined ratio. Has anyone heard that? Any of you with your interns heard of combined ratio? So the combined ratio is essentially outflows divided by inflows, which is what? Claims plus LAE plus underwriting expenses divided by premiums. It's not quite that simple. You'll see later in the class, there's two premiums that they use that you have to switch, but essentially it's that. So how much did you pay out divided by how much you brought in? You know, where's investment income in there? Doesn't exist, right? They ignore the investment income. So if you had a combined ratio of 105, what would that mean? Did you make money or did you lose money? Lose money, right? You paid out 5% more than you took in. Could you make money doing that? Is it possible? And there's something missing, isn't there? Investment earnings. Could you have made 7% on the investment and still make money? So it's possible you can have a combined ratio greater than 1. Huh?
Yeah, what is that on a UW?
Underwriting, sorry. I don't like the term underwriting because you'll just see underwriting is a really specific term, and yet the insurance industry calls it underwriting expenses. That's their term they use, but I think it includes a lot of expenses that aren't underwriting. But I'm giving you the technical term, but just think it's just all their other expenses besides what they pay their lawyers and their adjusters. Y'all know what an adjuster is? You have a claim and the person comes and they say, you call up State Farm and say, I have some hail damage on my house. They'll say, we're going to send an adjuster over. What is the adjuster going to do? Climb on your roof, see what damage you actually have. And see if you actually have that damage. You've probably known people are like hoping for a hailstorm because they need a new roof and they'd rather the insurance company pay for it than they pay for it. So that's the adjuster. That's what they do. Their costs get really big in a catastrophe. If you have a hurricane or earthquake, you have to pay for their salaries. They might have to go to Florida for 6 months. You got to pay for their apartment or their hotel. So it can get pretty expensive. But insurance companies break those costs out separately from the other costs. What if this was on 0.95? So you made money before you even made the investment earnings on the float. All right. A typical auto insurance policy has a combined ratio of 90 to 95%, which means before he even makes the investment earnings on the float, he's already got a profit. This is what we call negative cost float. And I think the way he says it, let's look. I think he says we're actually paid for holding other people's money. He says it here somewhere, right here. Our cost has been less than zero in about half of the years. What's another way of saying this that I just showed y'all? Our blank has been blank for half of the time.
Where your combined ratio was 1.
Our combined ratio has been less than 1 most of the time. That's what he's saying. All right. Our cost has been less than zero in about half of the years in which we operate. Half of the time, you look at not just Geico, this is all of his businesses. Half of the years, their combined ratio is less than 1. And then you add on top of that investment earnings, you can see why he likes insurance. When he sees a combined ratio of 95, it's like he's borrowing money at negative 5%. And he likes it. And you can actually Google this, or you don't have to use Google, but Warren Buffett and insurance float, and there's a lot of articles on it. The power of float, the secret sauce building wealth. I mean, it's central. Y'all know this is central to his entire business model. He might say, I thought he had Dairy Queen and Fruit of the Loom and Northern, but what is he saying? Yeah, I'm gonna borrow money at a negative rate from my Geico customers, and I'm gonna stick it in Fruit of the Loom and make this profit. So he's essentially looking at Geico as a cheap source of debt that he can invest in these other businesses. So it's central to his own business. I don't know why they put the S on the end of it. That seems so weird to me. It's not insurance floats, it's insurance float. But anyway, but you can see this is a pretty common topic. Now, some of them are pretty old articles, but you might even find him talking about it in an interview. He's still around, although Charles, his Munger, has passed away. All right, so the cost of float is this equation. And you want to bring all this into your paper. So hopefully you're taking good notes, because a lot of this will not be in the paper itself. So now I had this conversation at USAA. We had a brand new CEO. I got to know him really well. That was very good and very bad, depending on the day. He was a banker. He knew nothing about insurance. And we were talking about this equation here, and he actually got really mad when I was explaining to him what the regulators say. The regulators require insurance companies to include the investment earnings in their pricing. It's not in the accounting. We keep it separate in the accounting, but the regulators require the insurance company to give that investment earnings on the float, to give that credit, and when they price the policy. And he was like, no, I'm not going to do that. And I was like, well, you don't have any choice. The regulators require. And he got so mad. A good friend of mine was my first boss, who's in the room. He turns to her and says, Susan, is that true? He says, yeah, unfortunately, that's true. And he was so mad. It's like, that's our money. So his opinion was the investment earnings on the float, that belonged to USAA. That didn't go to the customer. And regulators say, no, if you make 5% where you're holding their money, you got to give them that in your pricing. So regulators don't separate them, but the accounting does. And when he talks about the cost of float, he does separate them. It's just this part. He's ignoring entirely the investment part. So when he says here, our cost has been less than zero, he's only including those claims, expenses. He's not including even the investment part of it. Now here's his segments. Geico, y'all heard of Geico. So he calls this year-end float. What's another term for this? These are actually the reserves that he has set up for these policies. This is how much he's going to owe these people in the future that the actuary set up. We'll talk about reserves later. So what's their biggest business? It's not Geico, is it? What's the biggest number you see out there? Gen Re. Gen Re is one of the largest reinsurance companies in the market. Huge company, 19 billion, back in 2001, $19 billion in reserves. And then he's got other. So now Geico is auto insurance. Auto insurance doesn't typically have large reserves because you usually pay your auto insurance claims pretty fast, right? You're not going to wait 9 months for an auto claim to be paid. So they tend to get paid pretty quickly, whereas some of these can be much, much larger. But yeah, Gen Re is a huge, huge reinsurance company. So barring mega catastrophe, our cost of float probably would drop from a 6% level down. But he says our cost of float in 2001 was 12.8%. So what was his combined ratio in 2001? He's saying it's 112.8. 112.8. That's what he's saying. All right. He had a combined ratio of 112.8. He's not, you see, I don't think he even uses the word combined ratio in here. No, that's not combined ratio. That's just combined. There's one. Combine, no, he's using the word combine in a, as a dictionary term, but not combined ratio. Well, he doesn't use that term, but I want to see it in your paper. Okay. This is where some students really mess up on the paper is they only go with the article and don't realize that class discussion is a big part of it. All right. So you want to make sure the combined ratio is in there when you're talking about cost of float because it's the best way to define it. So here's all the money he expects to pay out over the next few years that he's holding. That's really other people's money. And while he's holding part, he's going to invest it and make some earnings. Now, what do you notice about Gen Re and other in 2001 with their reserves? You notice a little jump. We're from 27 billion to 35 billion. So essentially what he's saying on the cost of float is that you think it's going to be negative 5%, but some years it can jump up to positive 15%. You have a major catastrophe, a major earthquake or something like that. Would you expect Geico's reserves to jump up in 1 year? What would it take for an auto insurance company to suddenly have massive claims?
A lot of callbacks.
Well, they don't cover them callbacks. That's not that wouldn't be Geico. Now, we may talk about, most product recalls are not insurable. We'll talk about that. But for Geico, you have to have an accident. So you might say maybe a winter storm, but have we had a winter storm that was so massive you'd really notice it? It's usually not, because most people stay home, right? What happened during COVID, the auto claims?
All went down.
Yeah, it was a really strange year. So we're going to talk about frequency and severity. So you may know what happened in 2000. Frequency did what? The number of accidents dropped dramatically. No, frequency went down because people weren't driving. 2000, they weren't driving. I ride my bike every day, and I can tell you, I can remember April of 2000. I was in the middle of Bandera on my bike. There was no cars anywhere. It was a blast. I was on a blast riding around. And then suddenly everybody starts going back, and now it's pretty dangerous. So frequency went down, but what did severity do? It jumped up. People were, because there were no traffic, people were doing what? Driving 100 miles an hour. And so when they crashed. So we had a strange year in 2020, but you can't see it in these numbers. I'll pull the numbers because Bloomberg actually has these numbers, and I can pull them in. You can see what these numbers are. It's really pretty interesting. But auto insurance, you don't normally see auto insurance suddenly jump a bunch. Now, what if they're doing homeowners insurance? Could that jump in 1 year? Yeah, you have Sandy, Hurricane Sandy, you have Katrina. Then you can see a massive jump. But Gen Re is a little different. So what does a reinsurance company do? Well, if you were to do reinsurance on your car, it essentially be like buying auto insurance where the deductible is like $18,000. So you'd have to have a really big accident before they're going to pay. So reinsurance is they're going to insure someone like the Twin Towers. We insure you, but your claim's got to be at least $1 billion before we pay anything. Which means when does Gen Re pay? Only when something really big happens. It's got to be massive. All right. So essentially what Gen Re is doing is stepping in when no one else can do anything. They're the kind of the last resort. And so they have large losses when there's major events.
Is that a company?
Gen Re is a subsidiary of
I was
Berkshire
reading that, but I
Hathaway.
couldn't figure out what. Okay.
Yeah, you don't hear as much about them. Probably the one you would know would be Swiss Re. So I told my actuaries last semester, if I could work for any insurance company, it would be Swiss Re. They came to USA one day, and I was just so impressed. So they have a really good website for reading articles and just some really, really good stuff. But Swiss Re is, I don't know if they're the largest. It's hard to say because Gen Re is a subsidiary, so we don't get all the information we'd like to know. I think Gen Re might be the largest, but it's between Gen Re and Swiss Re is the largest. The other large one would be Munich Re.
So everyday people aren't getting this.
No,
Okay,
I was,
okay.
I kind of confused that. No, reinsurers sell insurance to insurance companies. So USAA buys reinsurance just in case their hurricane losses go above $1 billion.
Okay.
So yeah, I should have said that's where that re comes in. Reinsurance, they insure insurance companies. I don't know if I want to accept. Now here's Munich Re, that's another insurance, and they have articles as well. If I were an actual science major, I'd be reading stuff from Munich Re, Gen Re. They're just the best in the business. And I would be interviewing with jobs with them for sure. All right. So where does he go from here? So he's saying, okay, here's float. We love this business because most years we're borrowing money at negative interest rates. Doesn't even mention the investment side of it, which is the other part that comes on top of that. However, every once in a while, we lose a lot of money, especially in reinsurance. But 2001 was an especially special case where we lost a lot of money in 1 year. And so there where he goes next is what did we learn? Now he gives 3 things that they learned. I convert these 3 things, I think, into 6 things. All right, so you have to read between the lines. So here's where you have to expand this article more than I have. And the funny thing is, the third thing, I don't really, you get free points if you just mention it. So the third one, I'm not saying it's not important, but it's not important to this class. His third one is only deal with ethical people. That's true for every business. Okay. So the third one, just throw it in there, you get full credit. So that one's easy. So the first 2 you can break into many more. And this is where you got to be really careful with the rubric. Make sure you know exactly what I'm talking about, because he has a lot of things in a very small amount of space, right? So what he's saying here is, I've got this cost of float, which is how much I'm going to receive versus how much I'm going to pay out. Most years, or about half the years, I receive more than I pay out. So I'm essentially have a negative cost of float. But every once in a while, I have a horrible year, and 2001 was a horrible year. What did I learn in that process that I need to learn going forward to protect myself on this cost of float that doesn't get out of hand? All right. And these are the lessons. And he has 3 lessons. We're going to broaden them out further than that. All right. I'm going to read them through them and kind of give you hints at it, and we'll talk about it. I want you to read this article before next Monday, because we'll probably cover this in Monday's class. So accept only those risks that you're able to properly evaluate. All right. There's 2 words you need to add to this discussion. And I've already mentioned them, so see if you can read my mind. One starts with an F, and one starts with an S. Any guesses?
Frequency and severity.
Frequency and severity. You have 2 dimensions of the statistics in insurance. Frequency, how often something happens, and severity. Life insurance, it's not frequency, right? Because how many times do people die?
Once.
Usually once. Right? Has anyone died more than once? Yeah, there's a few cases of someone getting lost on some desert island and they get their life claim and then they're found 9 years later. So they get 2 life insurance claims. But that's pretty rare. So life insurance, it's not frequency, it's the probability you die in any given year. But for insurance, it is how many claims are you going to have? It's frequency. And in severity, you might want to guess what severity is technically. So frequency has to do with the number of claims. What do you think severity is?
It's like how bad the accident is.
So how would you measure it though?
Cost of destroyed things.
Okay,
Okay,
you're getting close. Huh?
Maybe dollar amount?
Dollar amount, but expressed how?
Yeah.
The payoff expressed how? So you got to divide by something.
Injured?
Huh?
Injured?
No, compared to what they're paying.
So let me tell you, yeah, y'all trying to read my mind and I got a thick skull. So it's average claim. Frequency is number of claims. Severity is average claim. What happened in 2020? Frequency, number of claims dropped dramatically, but the average claim jumped dramatically. All right. So frequency is the number of claims. Severity is the average claim. We'll see that actually in some articles here, especially when we do credit scores. What do credit scores have to do with driving? Why do people with good credit scores drive better than people with bad credit scores? And what do actuaries say? We don't care. The data shows us that it predicts driving, and that's all we care about. Do you think your credit score influences your driving, or you think there's another factor that influences both of them? That's probably the case, right? Maybe responsible people have good credit scores and drive well. So why don't they underwrite on responsible people? How do you figure out if someone's a responsible person? Well, you look at their credit score, right? But when we get to that, this credit score, is it correlated to frequency or severity? So I'm not going to give you the answer, but we'll see. You could probably guess. We'll see. The people with good credit scores have fewer accidents, or when they have accidents, they have smaller amounts. And so we'll see. If you think about it, you might say, well, those two kind of contradict because people with good credit scores might drive more expensive cars. So that might hit, so we'll see when we get to that. But you see what it is. Frequency, number of claims, severity is the average claim. That's what he's talking about here. You got to add it to your answer, even though he might not use the word frequency anywhere in this. Well, it's there, but what page am I on? Page 1. Uses it one time. The frequency of actions decrease. So you used it once. And I don't know where I am now. So he doesn't. So again, here's something else that I'm looking for in your answer that is not in his discussion. So the first thing he says is don't write insurance if you don't have statistics on frequency and severity. There are companies that sell insurance, alien abduction insurance. How much data do we have on that? Not much, right? Would you sell that? Would you sell? I mean, what's the combined ratio on that? It's probably 0, right? You're probably not paying any claims. I don't know. I might take the risk, and if I have claims, I'll just go insolvent and say, sorry, I didn't price it very well. You know, much data. What's an insurance that you would hate to write because you just don't have much data? So something that's new. So right now people are worried about AI. How do you insure AI? What's going to go wrong? We have people predicting. Do you know that the predictions for AI destroying the world has a higher probability than the prediction of global warming destroying the world? Did y'all know that? The people who know AI think there's a much higher probability AI will destroy us all than the people who think global warming is, so how would you ensure that? Autonomous vehicles. Do we have data on that? We're collecting data on that. Do they have more claims, fewer claims? Is there a scenario where someone could type, cyber tap into that and have all cars crash all at the same time? So that's what he's asking here. What is he talking about in this case? Talking about terrorism. How much data do you have on terrorism risk? Not a lot, right? And it's a difficult one because there's not a lot of frequency and it follows a power curve. So there's a lot of small events, and then occasionally there's a massive event. That's really hard. So that's what he's talking about here. Not much data on severity or frequency. And after that, evaluate all relevant factors, including, and kind of here's a new one, remote loss scenarios. So when he says you've got to evaluate frequency and severity, he says you also have to understand the tails, the extreme tails. So something that's pretty normal 99% of the time, 1% of the time it kills you, you're probably gonna have to look at that 1% and understand it, because 1% is pretty high. I mean, I guess most of y'all would believe that, right? If you're gonna do skydiving and you go walk in and they say, hey, we're really, really good. We did 1,000 trips last year and our loss ratio is only 1%. Only 10 people died last year. Would you do any skydiving with that firm? That's a little bit high. So 1% is a pretty high. So they're saying, hey, you got to look at that tail. 1%, that means you could have gone 50 years without any claims, but that 1% happens. So there's a huge one here that he doesn't talk about, but that we will talk about, which is earthquake. Earthquake, we don't have enough data on earthquakes to really understand them. We talk about California, but there's actually some places in the United States that have huge earthquake risk that no one's talking about, like Kansas and New York City. And why doesn't anyone talk about them? Because it hasn't happened in centuries. So does that mean it's not going to happen? What's going to happen? Y'all know we have a big fault line up through Austin, right? Have y'all seen it? It's really beautiful, isn't it? You got the hill country and it's so gorgeous. Well, that's a major fault line. What would happen if Austin had a major hurricane? Are they ready for it? California's ready, right? They have to build all their houses and buildings, the code. So remote loss scenarios. And then it's not just that when it happens, you understand the frequency, you also understand the severities. So what happened in California with Northridge is they had these buildings that were built to withstand the earthquake. They withstood the earthquake. The insurance company said, wonderful. And then the engineers walked in and said, yeah, the building's still standing, but it's not usable. We have to tear it down and rebuild it. Well, the insurance company's like, oh, wait, my average claim just shot up dramatically. I thought I just had to repair the building. You're telling me I have to tear it down and rebuild it. That changes things, all right? So you got to understand when you're properly evaluating, you got to understand those remote events. And he has one other thing. Even after all of that, you're still going to make money. Now, I'm going to put one caveat on this because I don't think he believes what he just said. So make sure in your paper you get this because I do look for this. I think what he is saying is expected profit over the life, over several years. There's no way a reinsurance company is going to make a profit every single year. It's just not the nature of the business. It's not possible. They have to have, otherwise they're not doing their job. They step in on those extremes, and in those years, they're going to lose money. So there's an expectancy of profit. So what he says is it's going to be a little lumpy. That's the way reinsurance is. But with all those lumps, when you look through the whole cycle of the underwriting cycle over several years, it's a profitable business. Now, what does he mean by profit? He doesn't mean a positive accounting earnings. He means a good return on capital, right? Or good return on equity. So profitable doesn't mean he makes 2%. Profitable means he makes his cost of capital. So that's what he's talking about here. All right. So you see, we already got 3 things there. Here's the 4th thing. I don't know if you believe him on this. If he can't do that, if he can't price his product to make a profit because of competition, he says, walk away from the business. And he even uses a word I can never remember what it means. I know what it means. It means you're indifferent or that you're happy. It's one of those two. I think it's the happy one. Yeah. He's not just saying you walk away from the business and you're indifferent. He says you walk away from the business and you're whistling and you're happy. That seems a little unbelievable, but
What do you mean by you can't price it?
yeah. So he looks at this product and said we should be charging $1,000. But the competition is charging $900. He knows they're wrong. They're just trying to get business. He says, either pay $1,000 or go somewhere else. And you say, I'm going to lose. If I have to lose market share, I'll lose market share. Yeah, go to competitor and do that. That's what he says he's going to do. This is probably more true for Geico because the auto insurance side, there are auto insurers that price to lose money to pick up market share. And he's like, you can have it. I don't want that business. Do you think he's really sanguine about it? I wouldn't think so, but he doesn't have that big of a problem on the auto side, mainly because his expense ratio was so low that generally, even when competitors undercharge, he's still pretty competitive. So he has a huge advantage. I remember, well, when USA restructured, this is one of the reasons it restructured. Our expense ratio was 30%. So remember here, underwriting, where is that? This underwriting expense, ours was 30% of our premiums. Geico's was 18%. USA was almost twice as expensive. And that's when USA cut its workforce 25%. We had no choice. We were so uncompetitive at that point. And Progressive was like 19%. So Geico does have an advantage. Where does Geico spend this money? They spend a lot of money on advertising. So that's a big part of it. But they don't have commissioned sales agents. They don't, they save a lot of money. So he doesn't have, it's a bigger deal in auto insurance because there's companies that really do underprice, but he has kind of a starting advantage. All right, so I think I said there was 4 things in there, but we'll talk about it more when we look at the rubric. All right, then he talks about this word here, aggregation of losses. So what he means here is the domino effect. A major event happens and it causes multiple things to happen that he just wasn't looking for, either from a single event or from related events that were kind of all happen together. So you got to make sure you don't have something that when everything gets correlated together, the losses are just unbelievable and they make you go insolvent. And then he uses, I love this, I don't know if he wrote this, But I love this sentence because it has an alliterative. He says they ceaselessly search for possible correlation among seamlessly unrelated risks. Isn't that a great sentence? So in your answer, the word correlation better be in your answer. What he's saying is we expected these two things to be uncorrelated, and 99% of the time they're uncorrelated. But when you got way out there on details, suddenly stuff that was unrelated suddenly became correlated. That's what he's talking about in the workers' comp. Say, hey, these 6 employers or 7 employers, they're all in different businesses. They have different risk. We don't have to worry about workers' comp with them. They're all different employers. And then what did he discover? They were all in the same building. Maybe one was in Tower 1, one was in Tower 2. You think he ever thought about both of those towers being attacked at the same time? What happened a few years before 9/11? They had a terrorist bomb in the parking garage of the Twin Towers. Do you think that should have made him think maybe having workers' comp on employers in these 2 buildings? Maybe, but he didn't think about that. So you got to search for these things. That means you got to think really hard. How could these things become related? All right, we'll have to stop there, right? So I'm trying to help you get through this article. I want you to see that there's more in this article than just the article itself. All right, so read this article. We'll finish up the discussion in class on Monday, and then we'll get into economics of it.